Welcome, good evening, and good morning to everyone that's here. Now, today's stream, it's going to be similar to yesterday, but we are going to be talking about HIMS and HERS. Right, so I think recently I haven't had much time to cover this company because I was looking at 10 other companies, but this is ultimately still my second biggest position in terms of allocated capital in my portfolio. Now, in recent times, Oscar has overtaken it as the second place position in my portfolio. However, I do believe that there is still a lot of room over here for HIMS and HERS to continue running. So just give me a second as we set everything up. I will be taking you through the portfolio once again at the start of the stream before we dive into the stream proper. All right, let me set this up. Right, good morning, everyone. Okay, stream should be set up. I think I got my files prepared. Do I? So I think with HIMS, some of the biggest news have been around the Novo Nordisk partnership ending. I think that has been about a couple months ago. Since then, their stock has fallen. They have reported their earnings. I don't think I did a review over their earnings. I think by now, a lot of people have given their commentary about HIMS and HERS earnings. And I think in terms of new information, I think everything that has to be said about their earnings, more or less, is already out there. Today, I'll be trying to give a slightly different spin on how I look at things from the data perspective, and basically pick out certain pieces that have been said about HIMS and HERS over the last couple of weeks, either by Andrew or Yumi, and then basically input that into our valuation model. Now, the valuation is what is going to be slightly different, because in the past I have done just a very rough modeling out of HIMS revenue, and basically I've done that in a little bit more detail, so I'll be taking you through that. And then for those of you who are perhaps newer to this, I'll be showing you why HIMS actually fell on my scoring framework recently, and why that is not always a bad thing. Now, let's start by looking at the portfolio. Just give me a minute. So if you notice a discrepancy over here, yesterday this was 600 over 600 and around 65,000. We took out $20,000 because I have some financial commitments in terms of for 2026. So I just wanted to be prepared for that. So apart from that, and basically what was the, in a sense, sacrificial piece is basically UNH sold it at $62.50 after getting in at $20.50. So over here you can just see this just happened today. And yeah, so that would amount up to around 30,000, but we only took out 20,000 because that was the profit, right? So with that said, the remaining 5 contracts of UNH, I don't plan to sell anytime soon. I expect this to reach around $100 or so before I even consider getting out of UNH. And because what I've done, especially coming towards the end of the year, is that I have set up a lot of my financial obligations such that they are all dealt with. The 2026 financial obligations are all dealt with by 2025. Hi, good morning, Alvaro. Nice to see you here. Yeah, so personally, for me, I like to plan things at least, 6 to 12 months in advance. And I know I do have some financial commitments coming up, some business opportunities, and certain family stuff that I would need the cash for. So because of that, decided to, since the amount there has already tripled, I have decided to take out somewhat. Now, the reason why I have the 5 contracts remaining is because I do believe UNH can easily get past $400 per share. And I think that is when I will consider trimming the rest of the position and to basically redeploy that into other companies. And I think for me, the way I look at this, because I've already made back the entirety of the capital, this position over here is now pure profit. So I'm just going to be using this as a piggy bank, especially in the next couple of months. Is if we do see some volatility and I need some extra cash, this is where it's going to be coming from. Now, one of the things I guess you guys will notice is that now we got early assigned 100 shares of Lululemon. And I guess, it's actually a good thing for the person that assigned the shares because he got me to buy them at $190. And today, Lululemon is down all the way to $160 over here. So I don't like to sell calls on a position on days where, the stock is basically under pressure, which is like what we're seeing today. I don't see why, I'm not sure if there's any reason why it should be down and 3% today. But yesterday, when I was looking at the 10th of October 175 calls, those were at around $4, which was a lot more attractive than what it is today. And so because of that, that's it. Not in a big hurry to be selling covered calls over here. I was looking at just doing it, 180 covered calls on the 19th of December. Basically, I guarantee, unless it continues to fall further, if it doesn't, if it stays around 170 to 180, by then I can exit the position profitably. However, that would mean having to lock in this $19,000 of capital, which is now only around 16,000. And personally, for my style of investing, the reason why sometimes I have all these smaller swing bets is so that I know if I do have to take a loss, if there are better opportunities in the market, for example, if SoFi falls back down below $20, then I would be more than happy to take a $3,000 loss in Lululemon to buy more SoFi, right? Because I can I can easily make back that $3,000. So that's how I look at risk. That's how I actually manage the portfolio and adjust for losses. Okay, so I'm very clear with myself. UNH is like a piggy bank. Lululemon, also somewhat of a piggy bank. I'm going to sell very aggressive covered calls on a green day. I won't be doing it today because the stock is red. And yeah, I think everything else is more or less the same as yesterday. I think we are starting to get a little bit of a breakout in Grab. So after holding this in the $4.90 range over the last 1 year, finally, we are getting some joy over here, although it's not, I guess it's not that much. It's just around 16%, right? But at least this is a significant move. I mean, I've been seeing it bounce between 450 and 550 for the longest time. So I think what we really want to see is that this comes back down, test the resistance, and then as new support, and then basically bounce back up again. Let's see. Yeah, so I think we can see that, this is really a breakout. Usually, I think a breakout is confirmed when it has come back down, tested, and then, rebounds again. So I'm not too sure where that will be. Like I said, I'm not super big into technicals. I use it very on a very basic level just to understand when and where to buy entry and exit points for my companies, right? So apart from that, I don't really do much with technicals. I use very basic support, resistance, Fibonacci retracements. That's about it, right? So nothing too fancy over here. With HIMS, still the same. I believe there are some things that I did yesterday after. So I don't believe I spoke about this yesterday. I have about 1,500 shares of HIMS. I've always said I wanted to get to 2,000 shares, which is why I sold the cash put over here at $44. However, yesterday, I couldn't pass up the opportunity to actually sell 1 month out covered calls on HIMS at $65. But just to cover around 500 shares, right? So to me, the way I see this, I've gotten in at around 44. If I'm forced to sell at 65, 500 shares, that's basically making $10,000 capital gains in a short period of 1 month, plus the premiums of around 1,500. Why 1,500? Because if you can take a look over here, I have a strangle on this position, 10th October, $44 cash secured puts and $65 covered calls. So both of these, cannot be true at the same time. The stock cannot be 65 and 44 at the same time. So eventually, at the end of it, on 10th of October, I will be getting $1,500 worth of premium, and either I'll be owning, an extra 500 shares at $44, which is around my cost basis, or I will be, selling 500 shares and then basically making $11,500 in the space of 1 month in this position. So to me, with that cash, 1 month's time, I'll be happy to sell a cash secured put to buy back the entire position. So that's how I'm looking at it. So with the way I run the wheel strategy, like I said, around 30 to 40% of the position, those that I put up to be covered by covered calls, I'm not so emotionally attached. Like this 1,000 share, actually, to me, my limit for HIMS, because it's such a volatile company, at any point in time, I should always have around 500 shares of HIMS. The reason is they can run very quickly. I do not want to be left, trying to chase the stock. So no matter what, I want to have 500 shares of HIMS in the account. The other 1,000 shares, I'm happy to use covered calls to generate a premium on them. Similarly, for SoFi, this is new. I have around 11,000 shares. I don't plan to sell SoFi anytime soon. I think I've said yesterday that the earliest I plan to look at offloading some of my SoFi is only once they hit the $40 range. And so because of that, I sold 2,000, I've sold 20 covered calls at $30 and then another 30 at 32. Again, this is one of those things I've gotten in at 8 and then wheeled it up all the way up to, I think, 50. I got that my position called away one time because I was being overly aggressive. But so because of that, that's why you see the average cost basis also at 15. Yeah, and that was during the period of time when I was changing my brokerage anyway. So I'm not someone that is particularly fussed by the average price. I've come to realize over the last couple of years that the only number that matters is this thing at the top right over here, your total account value. No other number matters. As long as this number is going up, as you can see, we're up 50%. This is literally from this year. So I think, it doesn't really matter what the cost basis is to me, because when you're running the wheel strategy, you have to really detach yourself from all these cost bases that you see over here, because ultimately, even these are inaccurate. Like if you take a look at HIMS, this would tell you that my cost basis is $44. But if you account for all the premiums I have taken out over the last couple of months, I've seen my spreadsheet that my cost basis is actually in the low 30s or high 20s, somewhere there. So I don't really pay much attention to cost basis over here. But all I know is that for me, the target for SoFi is at 45. I will start perhaps trimming 30 to 40% of the position to reallocate into somewhere else and holding the rest for really the long term. Right? So that's how I'm running my SoFi position. UNH, I've already covered it. Grab covered it. And Oscar, nothing much over here. $18, I think it's good that it's seeing a pullback. And I think we really want to, because I think the stock was getting a little bit overly excited after the recent news. So I think it's always good to let the stock cool down a little bit before its next leg, as long as it forms a higher high. So let me take a look at the Oscar chart. Yeah, actually, if you look at it, I find Oscar a company that I come to realize that it's really been trading like in somewhat of a range over the last, maybe since February of over the last 1.5 years, right? So I know a lot of people do a lot of technical analysis on this chart and things like that, but honestly, I wouldn't say I'm super in tune with what's going to happen next for Oscar and all the lines and things like that. I just know the fundamentals of the business are strong. I'll be doing a more detailed valuation, like what I'm doing for SoFi and HIMS for Oscar soon. And and from there, I hope we can see why I see some value in this, right? At least a double from where we bought it, around $14, $15 range. So $28, $30, I think is actually doable. So some people claim that this is going to pull back and then bounce off. I really don't know. And for me, I don't really bother with this as well, because doing the wheel strategy, you don't really need to be too bothered in a sense by this, as long as you understand volatility and how to react accordingly, right? So that is basically the entire portfolio for today. So with that, I want to dive into HIMS. I want to cover some of the news that has happened recently, and then from there, hopefully, we can dive into the valuation. Alvaro asked, "Do I cover Super Microcomputer (SMCI)?" Not really. It's not a company that I'm particularly looking at in the semiconductor space. Semiconductors, I look at Nvidia. I have a big position in AMD, TSMC, and yeah, recently, I mean, with the recent Broadcom news, I'm quite interested at looking at Broadcom. Yeah, but I keep my semiconductor plays fairly simple. So Nvidia, AMD, these two are the biggest positions. Okay, let me rephrase it. AMD is the biggest position. Nvidia, it's one of those things where I always feel like, this is such a big market cap company. I will buy it when I want to de-risk portfolio. Yeah. So I usually buy the mega cap companies when I want to de-risk my portfolio. And that time at the moment is not right now. So, that's why I'm in AMD. Yeah, but to me, the two biggest positions eventually will be Nvidia and AMD, and perhaps TSMC. So no, I don't really cover Super Microcomputer. Yeah, I know some of the content creators. They did a trade on it during the early part of this year, when there was concerns over their financial accounting, but I think everything turned out fine for them. Okay, so with that, today we are basically talking about HIMS. We're going to cover some of the news surrounding HIMS and HERS, and basically look at how that is going to affect their valuation going forward. Because I think there are some pretty interesting pieces of information that I'm not sure have broken down, right? So, in the last couple of months, I think one of the things that happened, you can see this report that came out on 5th of August. HIMS and HERS misses revenue estimates. I think this is for the first time in their company's history, and then they also had a quarter-over-quarter decline in terms of their revenue. So the first sequential decline in revenue, and this is in large part due to losing the GLP-1 weight loss customers, right? So the management actually mentions that during their earning calls as well. So I think where I want to start with HIMS and HERS, because I find that a lot of the narrative around this company is just, this company is a very fast-moving company. You need to get in fast. But I think beyond that, I think it's important for us to know the risk that are involved in investing in such a company, and to understand that, why is it certain people choose to trust Andrew Dadham and his team. So basically, if you take a look at this slide over here, is where I want to begin this discussion. This basically actually shows you the projection that Andrew Dadham and his team had for the business all the way back in 2022. So to them, what this means is that how they see the business of HIMS and HERS over the long term is that they will eventually become a business with revenue, with gross margins in the mid 70% range. Now, they're definitely there. Previously, they were operating in the 80% range. Over the last couple of quarters, if I'm not mistaken, GLP-1s do have a slightly lower margin profile compared to some of their other offerings, and that's why you're seeing some of the margin compression in the gross margin area. But even then, they're still within this target of in the mid 70% range. Now, long-term adjusted EBITDA of between 20 to 30%. Now, right now, if you take a look at the results, they are not close to 20 to 30%, but that is because they're reinvesting to the business. They have made a couple of purchases in terms of their pharmacy facilities. They have also recently announced their acquisition, or their intent to acquire Zava. So I think that is why you are not seeing them move towards profitability just yet. However, if you take a look at the projections for 2025, it was always the case that we never expected this 20 to 30% to play out in 2025, because in 2025, this was back in April of 2022. But in 2025, the management of HIMS and HERS expected them to, have a revenue of at least $1.2 billion, as well as an adjusted EBITDA of $100 million. Now, and I think if you take a look at the results today, you can clearly see that we are actually well past these numbers, right? Now, I think in 2024, revenue came in at $1.4 billion. If you discount the effects of GLP-1s, then you're going to get $1.2 billion. So they basically, their revenue at 1 year of schedule. Now, in terms of EBITDA, I think EBITDA came in at $80 million last year. So basically, by now, they're already on track to reach $100 million in 2025. Now, later on, when I deep dive into the numbers, I will bring this up again so that you can compare it for yourself. Okay, so over here, this is exactly what I was talking about. You can see the first red arrow is pointing to this blue bar. This blue bar represents the $1.4 billion of revenue generated by HIMS in 2024. And this is the revenue generated by HIMS on the last 12 months basis in 2025. So currently, this stands at around $2 billion, right? So you can see in terms of EBITDA, this was around 78 to $79 million back in 2024, and currently this stands at 154 million. Now, this is, you have to bear in mind, this is with the GLP, right? So I think the concern surrounding HIMS and HERS right now is that they have lost the impact of this GLP-1s, and people are worried that it's going to be affecting their business. But the management doesn't seem to be so concerned about that, because as recent as May, they have now renewed their projections, right? Because in 2022, they gave us their 2025 projections, and we have already established that they have achieved their numbers 1 year in advance. And so now in 2025, they're giving us the new projections all the way through to the end of the decade. And basically over here, they're expecting around $6.5 billion in revenue and $1.3 billion in adjusted EBITDA. Now, on top of that, they also say that they hope to reach tens of millions of members. I think 10 million members was the number quoted by Andrew Dadam, if I am not mistaken, right? Yeah, this is by Yemi, but I'm pretty sure in another interview or something, I think Andrew Dadam has also mentioned this 10 number. Later, I'll find the article for you as we dive through some of the websites. Now, over here, this was taken in the most recent earnings call that, over the next 5 years, we'll focus on 5 core drivers of growth that we believe will help bring this new vision of healthcare to tens of millions of customers. Now, with that, I just want to take you through what Yemi was talking about. So if you take a look at Okay, if you take a look at this announcement that they put out on their website over here, you can see this is where I got the screenshot from, building the future of our healthcare, our roadmap to $6.5 billion. So basically, HIMS is sharing with us how they plan to reach this $6.5 billion. So the first thing that they plan to do as their main strategy is to offer more personalized care for every individual. Now, I've said this many times. This idea of a personalized care actually is something that is a moat for HIMS against some of the biggest companies like Amazon. Because if you're going up against companies like Amazon, you'll always lose on cost, which is why this idea of personalization is very important in the healthcare space. And I believe in healthcare, this is an area of the market where, people are perhaps less price sensitive, because if you have certain side effects to certain medications, or if you have certain side effects to certain medications, or if you actually, how do I put this? If you are unable to consume medication in certain form factors, then, cost is not going to be top of mind, right? You want a speedy recovery in the most comfortable way possible. And so that is why personalization of care does become a moat for them eventually. So, expanding into health issues that matter the most, basically just saying that they have many different health verticals that they can expand into. Am I on the screen? Let me make myself a little bit smaller over here. Okay, so this is nothing new. Smarter, scalable care without losing the human touch. So basically, this is they are growing their own ecosystem over here, and basically improving how providers can engage with patients. So this basically leads to higher customer retention, people coming back again. And I think at the end of the day, this is where this area of the market is quite competitive. You can see LifeMD is one of the competitors in the space as well, and they are also touting their product or their platform as one that is top in class. So I think at the end of the day, the consumer will decide. And I think with HIMS, I think other than having the whole platform, the whole tech platform, they actually own the whole back end of the pharmacies and things like that, which I believe will become something of a moat for the company. Right? So to me, these are to me, I think I can see the direction of the company over the next couple of years. Then you can see over here, teaming up with the best in healthcare. Over here, they were talking about the collaboration with Novo Nordisk. Now we know that has therefore ended. But I think at the end of the day, HIMS is also actually positioning themselves, not trying to offend anybody, but wanting to work together with some of the bigger pharmaceutical companies. Now, whether or not these big pharma companies wants to work with him, that is a totally different question. But at the end of the day, I do believe that eventually we will see some sort of agreement, perhaps not with Novo Nordisk, but with someone else, right? And again, I think after the recent experience with what happened with Novo Nordisk, I don't think HIMS will be rushing into another partnership anytime soon. And the final one, which is taking their model global. This has to do with their acquisition of Zava. And I do believe that, this is something that I think, especially if it comes to, places like for some of more modern cities, I think this is going to be a product that is that is basically well received, because I do think, unfortunately, we are in a world where people are getting sicker. And I think there's going to be high demand for access to transparent and cheap, affordable healthcare, because I think the cost of healthcare is rising everywhere. It's not just in the US. We see it in Singapore as well. This year we just had price raises in our in our general insurance as well, and so because of that, I do see that there is a way that they can actually really expand their brand globally. Okay, so these are some of the ways that HIMS and HERS actually plan to hit their $6.5 billion roadmap. And at the same time, they have already told us that they plan to eventually, scale this into a 1.3 billion EBITDA business. So $1.3 billion out of a $6.5 billion business, that is, that's around 20%, right? Which is basically the low end of their EBITDA guidance. And we know that they actually do have the bandwidth to do even more than that. So in the most recent quarter, they actually told us that, we added 73,000 members quarter over quarter. So right now, HIMS and HERS has around 2.4 million members on their platform. Now, this was a 31% year-over-year growth. This number sounds quite nice. 31% year-over-year growth. But what you're going to see later on in the valuation, that this is actually their lowest growth number over the last, I would say, 12 quarters very easily. And I think a lot of that is due to the loss of customers that are subscribed on the commercially available doses of GLP-1s. And this is exactly what they have told us. Now, the thing is, across of all of the other verticals in their business, they are still growing quite fast. So this basically offsets some of the headwinds of customers lost because of the GLP-1. However, I think at the same time, it's not just the GLP-1s. They also, during this period of time, were actually transitioning some of their sexual health customers towards more premium daily offerings over the next couple of quarters. This is a transition that will take time, and they're excited to see a large bunch of their existing customer base transfer over, and 65% of new sexual health subscribers in the quarter benefiting from the daily offering. And the reason that they want to do that primarily is to increase customer retention. Now, the fact that 65% of new customers in the quarter wants to do that basically reinforces what I was saying previously when I was talking about LifeMD and their troubles in the sexual health space. I was saying that we don't really see that with HIMS. HIMS seems to be pivoting to a different strategy, and so that ramp up will take some time, and they may even already be starting to steal certain customers from them, which is why LifeMD spiked customer acquisition cost. So in the second quarter, apart from the slowdown in subscriber counts, another thing that affected them is the revenue generated per subscriber every month. This fell from $84 all the way down to $74, like they said, as a result of offboarding a portion of the GLP-1 subscribers. Now, I don't believe the entirety of their GLP-1 subscribers will be off-boarded their platform. I do believe some of them who has experienced HIMS platform over the last couple of months, sorry, they are still, they may still want to stay on. However, that number wouldn't be too big. So I'm not going to be banking on that. So I think at the end of the day, the most important thing is to understand that, look, the rest of HIMS business might be smaller than the GLP-1s, but they are growing at a very fast pace, north of 55%, which is why, despite the other aspects of their business, the sexual health, dermatology, and things like that, growing at 55% year over year, it's still not enough to fully offset the loss of members through the GLP-1s, right? So I think because of that, I think there are two things pulling the numbers down. GLP-1s, this was a shock to them. However, I think what they plan for is to actually use this period of growth that is being sustained by GLP-1 to transition some of their members over in the sexual health space. However, because this GLP-1 debacle happened with Novo Nordisk, what they are ending up with is basically a quarter where they now have two headwinds facing the company instead of just one. So that is why we are seeing poorer than expected results. And I do believe that management has shown the ability to execute in the past. You can see in 2022, when they made the promise that they are going to hit revenues of 1.2 billion in 2025, they were only making around $500 million in revenue. So basically, they promised a 2x, but if you remember the revenue number that we were looking at earlier, they basically delivered a 4x in revenue over the last 3 years. So I think this is a really, really competent management, and I'm not worried about this. I do want to see evidence of this actually happening. I want to see evidence of their strategy actually succeeding before I get a little bit more comfortable adding into that position or making that position even bigger. So you can see over here, the management knows that as well, and they did tell us that, we're making a conscious effort to, the reason why they want to do this change is because they're making a conscious effort to make the entire base of the sexual health customer a lot healthier. And as they start to lap these dynamics in 2026, which means that, they know that the sexual health customer will see a little bit of a slowdown in the next couple of quarters. But as they have easier comps in 2026, they are going to expect to receive a benefit, which basically means that they're expecting to re-accelerate growth in 2026, right? And not just growth over, any typical customer. Is customers that are sticky, that will stay on their platform because they are now using their daily sexual health offering. So apart from all of this, like I said, one of the main concerns around HIMS and HERS is their ability to compound medication. Now, Eli Lilly sued 4 GLP-1's telehealth startup, and I think why this was significant, and actually HIMS rose on this news, is that because after the Novo Nordisk partnership ended, a lot of people myself included, were worried that they would suffer a potential lawsuit, and what would happen is that this is going to be long drawn, their reputation is going to be damaged, even though they win. But that might not be the media narrative that we actually see around the company. Plus, at the same time, they might have to pay a hefty fine. However, I think the good thing over here is if you take a look at the court ruling, one of the main findings is that the arguments of Eli Lilly were quite weak, referring to compounding as a personalized medication consistent with established legal requirements. This is actually said so by the court. This was a precedent that has been established by the court. And with this being established, I do think it is a lot harder for Novo Nordisk to present a legitimate case in court. And I think because of this precedent that is being set by the ruling in California over Eli Lilly and their court case, I feel like this might be something that that actually lessens the risk of a lawsuit for HIMS and HERS, which is why you see the stock respond quite positively in recent quarters. So just yesterday, 2 days ago, they launched their testosterone treatment. Now, the testosterone, you see the thing about HIMS and HERS, what you have to understand is that they have the ability to extend themselves into many different verticals. Each of these new verticals has its own total addressable market. So it's a little bit hard to say that whether or not how fast the entire TAM is growing. Because if you take a look over here, testosterone market currently around $1.9 billion, expected to grow to $2.9 billion, basically close to a double in 10 years, which is around a 4.2% CAGR, right? And I think at the end of the day, 4.2 doesn't sound too impressive, but when you have testosterone treatments, and then on top of that, you have menopausal treatments, and then on top of that, you have other offerings in the sexual health, in dermatology, and things like that. The build out of their TAM becomes endless, and so that actually offsets the slower growth in the TAM over here. So that's not something we are too concerned. Now, earlier on, I also said that, HIMS, one of the ways that they plan to reach their $6.5 billion goal by 2030 is to expand their business globally. And you can see them doing that through this acquisition of Zava. Now, I've tried to find some details on this Zava acquisition online, but I think the results are quite inconclusive, because what I was concerned about is how much revenue are they going to make from Zava. But it seems like, when I search online, this ranges anywhere between $35 million annual revenue to $100 million annual revenue. So later on, when I'm doing my valuation, I'll be, assuming that Zava generates $100 million annual revenue, and I'm going to basically offset that against HIM's guidance and see where that lands us in terms of our valuation. Now, one of the things that I really want you to pay attention to, this is actually in their 10K, and this is something I want you to pay attention to before we get into the valuation proper. Now, if you see in this part of the 10K, HIMS actually made a disclosure about how much of their revenue was made up of GLP-1s. Now, I've basically enlarged this thing because although I've tried to highlight it, I realized the font is actually quite small. So hopefully this is easier for you to read. And it says that our GLP-1 offerings primarily consist of personalized semaglutide and generic liraglutide, as well as commercial doses of semaglutide and branded Wegovy for partial period during the first half of 2025. So during the 3 months and 6 months ended in June 30th, 2025, our GLP-1 offerings generated approximately $190 million and $420 million respectively in online revenue. Now, what this actually means is that in the 3 months ended June, which means between March and June of 2025, they generated 190 million. Between January and June of 2025, they generated 420 million, which is inclusive of this 190 million. Now, what this tells us is that the branded GLP-1s basically helped them generate $230 million in revenue in 2025, in the first quarter of 2025. Now, this is an important number to remember. The reason is because we're going to offset this with their revenue and basically see what people are concerned about. And then I'll explain to you later on why that may not be big of a concern. At this point, before we get into the valuation proper, I'm not too sure whether anyone has any questions before we get into the valuation. Let me take a drink. Give me a minute. All right. So is there any questions? If not, I will carry on. I think one of the things that we have to pay attention to is how they utilize their 503A and 503B facilities, because if I'm not mistaken, 503A facilities are basically pharmacy facilities that cater to the individual patients. They are not allowed to, they're basically not allowed to mass produce, right, or distribute in bulk. So, what HIMS have told us is that moving forward, they won't be able to use their 503B, their outsourcing facilities, to produce GLP-1s anymore. And because of that, the revenue per order is going to be lesser, and to expect headwinds because of that. So basically, when we do our valuation, that is something that we want to account for. Okay, so let me take us through our valuation. Okay, that's my file. All right. Eh? Why is it not appearing? Give me a minute. HIMS. All right. Let's take a look. The numbers. Okay. So what you are seeing over here, I hope it's big enough. If you can't see, please do let me know. Have to zoom this a little bit further. Now, what you are noticing over here, the first line actually shows you the total number of subscribers on HIMS platform. Now, and this is what I was saying earlier. The first thing we want to pay attention to is the growth rate of HIMS and hers. And over here, you can see that in the past, they tend to be growing. Previously in 2023, they were growing in the 70% range. Then this was steady in the mid 40% range for quite some time. In Q1, this fell to 38%, and then in Q2, it fell even further to just 30.8% year-over-year growth. Now this fall in growth from 38 to 30% is fairly drastic, and management has already told us this is down to basically having two headwinds at the same time, and I believe that management thought that because GLP-1s were supposed to drive growth company, they were going to make use of that opportunity to transition their sexual health customer. Now, they did not expect that Novo Nordisk was going to suddenly end the partnership the way that it did. And so because of that, this basically artificially generated another headwind for the company. And so why you're seeing this slowdown in customer growth is because of these two headwinds, right? The transitions of their customer over from the on-demand sexual health medication to the daily premium offering, and then losing customers from GLP-1s. That's the first thing. Now, management has also told us during the earnings call that because of the number of people leaving their platform due to GLP-1s, they find it very hard to measure marketing efficiency. Now, because of that, they have been a little bit more conservative with their marketing efforts in the most recent quarter. And we know, and I think this is something that we have to expect as well, that as they launch their testosterone offering 2 days ago, and they are going to be, driving a lot of marketing into this channel, and I believe we are going to see a little bit of a tick up in terms of their marketing spend. I mean, they have told us before that the way that they work is that marketing spend tends to be fairly consistent until they are launching a new product, and the quarter surrounding that launch, that is when you'll see a slight boost in marketing spend, which definitely, if you are someone that keeps track of the customer acquisition cost, that is going to spike up during those quarters, but that is basically a feature of the company and it's not a bug. So that's something. I mean, they have shown over the last couple of years that this is a model that has worked for them. As long as the gross profit margins are able to keep up in the mid 70% range, this model actually is sustainable. So if it works for them, that's fantastic. And they are showing us that they have a payback period of less than a year. So that's all good over there. And what you can see over here is that the number of personalizations out of the total number of subscribers, you can see that back in 2023, 20% of the total subscribers were personalized or made use of their personalized offerings. However, now this has increased to 61% in Q2 of 2025. So in a period of 2 years, this number of personalized subscribers grew from 300,000 to 1.5 million, just under 5x, right? So it's around 4 point something x. So I think this is impressive, and this is basically a group of customers that are going to find it very hard to leave the HIMS and hers platform thereafter. All right. Now, from here, I think you can see this is their average monthly online revenue spent per subscriber. This has fallen down back to $74 after losing some of their GLP-1 customers. So this is nothing. I think nothing to be concerned about. I think what is going to be interesting is that moving forward, where will this level out in Q3 and Q4? So I think the numbers that they put up in Q3 are going to be very important, because we'll use those numbers to actually project out into the future. So I think there are a couple of dynamics here at play that is going to affect this. They are losing revenue from GLP-1 customers. However, that also frees up their pharmacy facilities to actually produce more of other kinds of medication and to go after patients in other health health verticals. So it's not just that because they don't have GLP-1s, they are going to stop, generating revenue anymore, because they're still going to be operating their pharmacy facilities, and they are probably just going to target other areas of growth. So I don't think that we will see a reduction all the way back down into the $53, $54 ranges again, but I do think that we level out in the $60 range, and as they add more verticals over the coming quarters, that we're going to see these numbers slowly increase once again. Right, so to me, I'm not too concerned over here. If you take a look at how the graph actually out, what you're seeing, this first graph over here, is the total number of subscribers on the HIMS and HERS platform, as well as the monthly online revenue. So you can see for a very long time, as they grew subscribers, the monthly spend every single month stayed relatively consistent in the $50 range. This spiked up due to the GLP-1s back in the Q3 of last year. So I think honestly, a lot of people that I've spoken to are concerned that this actually falls back down to the $50 range. And I think the management also knows that, which is why they are transiting some of their sexual health customers over to the daily premium offering, right? Which locks them in a subscription. And then at the same time, they're moving fast into different verticals like testosterone as well as menopause this year. So these are two things that will definitely offset that. And going into 2026, as we see the effects of the transition of the sexual customer on daily offering, that I believe is going to be something that is accretive to their business and going to drive up this monthly revenue per subscriber as well. Okay, so over here, let me zoom this in. I've broken down their revenue into online revenue, wholesale revenue, and then this is their total revenue. So you can see this is the first time on a quarter-over-quarter basis that this has actually declined. So let me see, where is it? Oh, sorry, this used to be a Grab. This used to be a Grab Excel file where I just wrote over it. You know what? Let me just, yeah. Give me a minute. I have to take a quick call. Okay, give me a minute. Let me see whether or not this is correct. HIMS. Yeah, because I was using the same format as what I did for Grab and then after that, I basically pasted over HIMS data. So I forgot to relabel some of the charts. So you can actually look at how I do this. I keep clicking on the wrong thing. Select data, HIMS revenue. Okay, so this is going to be, yeah, all the way over here until Q2 of 2025. This is going to be over here. Yeah. And okay, you know what? I'm going to plot their gross profit margin, because this is something that is actually important for them when they because this is something that they track very closely and is closely correlated to, yeah. Okay, so what you're seeing over here, let me zoom this in for you, is that over the last 4 years, their revenue has been consistently increasing until the most recent quarter, where you can see a slight drop off. Now, during this period of time, as they are increasing revenue, you can see actually their gross profit margin has been increasing up in the low 8% range. Now, only after they introduce the GLP-1s into their product offering that you can see this start to level off again. And I don't think it is a surprise that as they offboard some of these customers, that use GLP-1s, you see their margins re-inflect upwards once again. So I do believe GLP-1s is one of those products that have huge growth potential in front of the company, but at the same time they also compress the margins, right? So it's not all bad news that that we are starting to see them lose some of their customers from GLP-1s. I think if you actually offset some of these growth, you can actually see that this number over here basically is fairly in line with what to expect. If you basically expect them to grow in this manner fairly linearly, you can still see that they're more or less overperforming because of GLP-1s. But even if you remove GLP-1s, it's actually not that concerning for the company, and it's good to see that their margins are re-inflected up again. Did I see the model DCF? No, I didn't. Actually, you know what? I later on, you can take a look at my DCF. I feel like the DCF is fairly inaccurate for the very reason that they are not optimized for free cash flow at the moment. Yeah, so I do find it a bit hard. I think the multiple approach might be more accurate, and I do both and combine the results together later on. I didn't know they did DCF, but I'll go and search it up later on. Yeah. I usually rely on HIMS House for a lot of the news around legal issues, because I think they have a lot of lawyers and people within the industry to come onto their podcast and talk about HIMS, and that's where I rely on for a lot of the news, and then use some of these things to put together my own valuation. Hi, Vanessa. All right. So with that said, you can see gross profit margins pretty high. Now, the EBITDA margins, this is what they are saying over here. I think they are aiming to achieve 20 to 30% adjusted EBITDA margins. Currently, this stands at around in the high single digits. Last quarter came in at 11%. But I think this quarter, due to reinvestment back in the business and things like that, this has fallen to 7% once again. And I'm personally not too concerned over here. We have seen the ability of management to execute time and time again. And I believe that they can very easily get to that 20% number by 2030. So no concerns over here. Okay, so everything here thereafter is pretty straightforward. The only thing I want to point out is this cash flow over here, which has turned negative. Let me use fiscal to just show you some of the relationships between some of these numbers, which is much easier than having to plot this out by yourself. And then from here, we'll go into looking at the valuation proper. Now, before I take us through some of the numbers, is there any other questions so far? All right, if there's no question, let's take a look. Now, if you go into the financials, I think what you will notice is, if I go switch this to quarterly, let's take a look at cash flow statement. This is their operating activity. So you can see this was actually growing quite healthily. Of course, in the early years when they just IPO'd, you can see that this was fairly unstable, but in 23 and 24, even in the early part of 2025, you can see this growth was pretty exponential, right? So this is what really got people excited. And then in the last quarter, this actually inflected downwards. Now, management has told us that they expect to inflect back to growth in the second half of 2025. So this is likely going to be a one-time thing, right? And then you're going to see a similar trend for free cash flow over here. So I think a large part of this is basically reinvestment back into the business. That's why they are doing this. I would consider this one of their kitchen sink quarters. Like, since Novo Nordisk has already screwed everything up, let's give investors all the bad news at once, and then let's rebuild from there. So I don't think this is something that I'm particularly concerned about. I can see it trending upwards. Yeah, but like I said, still such a company, I really expect them to continue reinvesting back into the business. So to me, it's really not a concern if they do decide to actually, if they do decide to to basically take a hit on free cash flow just to reinvest and to expand their business. I think if you think about their plans to expand globally, there's definitely a need for them to eventually touch on more of their cash flow in order to carry out some of these investments. All right, so with that, so I need you to understand, revenue has been growing, subscribers have been growing. The other core parts of their business, dermatology, sexual health, and these other segments have all been growing at 55% year over year. Now, the reason why we are seeing a drop to 30% year over year growth in subscriber count, it's largely because of the losing of customers in the GLP-1 space. Now, but that is not, that is basically a cherry on top for them. It was actually a surprising growth driver. Now, the fact that they don't have it doesn't mean that their entire business is basically ruined right now. I think what people fail to understand is that they think that because I think one of the largest concerns around HIMS in the most recent quarter is that since you don't have any more GLP-1 revenue coming in with Novo Nordisk and things like that, then are their revenue really going to slow down? Because if you take a look at the core holdings, and later on I'll show this to you, what you're actually going to notice is that the main concerns that a lot of investors and a lot of bears have is that, oh, you know what, HIMS is not going to be able to grow revenue because their core segment is actually declining. So if you take a look over here, let me see, where did I put my core segment for? Okay. So let me zoom this in for you. So like I was saying earlier, the main thing over here that you need to understand is that in Q1, $230 million out of their entire revenue comes from GLP-1s, and $190 million in Q2 came from GLP-1s. Okay, now with that being said, you can see the concern over here is that when you compare, when I take out the GLP-1s from their entire revenue, the core revenue comes in around 356 million in Q1 and 354 million in Q2 of 2025. In Q1, this was still at least a 28% year-over-year growth. However, in Q2, this was only a 2% year growth. And because of this, people are saying, look, HIMS core businesses are slowing down. However, I think I have no proof of this. I'm looking to see that this is true in 2023. I have reasons for my assumptions, but like I said, no concrete proof right now. I feel like because they are not going to be able to use their 503B facilities to produce GLP-1s, it doesn't mean that their 503B facilities is going to be sitting idly there, not doing anything. They are going to be producing other drugs as well, and those drugs that they produce, the capacity that perhaps they perhaps manage the capacity of the facility such that the focus was on producing GLP-1 medications, and that is why you can see the revenue mix switched to predominantly or being heavily skewed towards GLP-1. Let's put it that way. However, with the dissolving of this partnership over here, they can go back to grow, producing more products and pushing their other segments of the business, which I believe will actually make up for this $190 million. Now, the reason why I say that this is possible is because HIMS and HERS are still maintaining their full year guidance of $2.4 billion in revenue. Now, this is where the Zava partnership comes in. 2025. Now, for HIMS and HERS in 2025, they're expecting $2.5 billion in revenue. So, okay, this is in $1 billion in revenue. Okay. Now, right now in Q1, they have done this. In Q2, they have done this, which means in Q3, I'm just going to make it very simple. In Q4, let's take out these two numbers and divide by 2. They are expecting around $680 million in order to hit, oh sorry, this is 2.5, it's 2.4. They're expecting around $630 million in both Q3 and Q4. If you take it that they are equal, I don't think that they are equal. How much each quarter will come in, I'll do that in my earnings video. But the basic assumption over here is that, hey, look, in Q1, Q2, we are doing this much, and in Q3 and Q4, in order for us to hit this number, we actually need to grow at $634 million. Now, if the concern is that GLP-1s are going to be a core revenue driver and they are not going to be able to achieve these numbers, then they would have lowered guidance. But the fact is that they did not lower guidance, and that actually tells me, the capacity of their farms that are being used to serve the GLP-1 customers will now be turned to ramp up production in their other verticals, which is why they are confident that they can actually make up some of these numbers. Now, people are also saying, you know what, the Zava partnership is going to make up for this, so it's actually unfair. They're not making that much revenue. But may I remind you that Zava is making $1 million per quarter. Okay, $1 million per quarter, which means that every quarter, $1 million per year. Oh my goodness, I can't speak. Zava annual revenue is anywhere between $35 million and $100 million. So sorry. So with that, it means that if you use an estimate, they bring in around $25 million per quarter. Right, they bring in around 25 million per quarter over here. So let me use this, drag it down. Now, what am I doing over here? I want to see how much is their core business, how much does their core business need to grow? So let me explain what I'm doing over here. We know that HIMS and HERS management has already told us that, hey, we are expecting full year 2025 revenue to come in at $2.4 billion. Now, despite losing their partnership with Novo Nordisk, they reiterated this number again, which means that they believe that the capacities that they have freed up in their pharmacies are now able to actually generate medications for their other business verticals, and these other business verticals, the extra medication that they can actually produce will go towards making up for some of this revenue. So in order for them to hit the $2.4 billion revenue target in 2020, it means that in Q3 and Q4 of 2025, they will need to generate around $634 million in revenue. Now, what is interesting over here is that they are going to acquire Zava. They've already made that announcement. However, I don't think that this is going to happen in Q3. It's likely going to happen in Q4 because there's only 2 more weeks left in the third quarter of 2025. So I think they'll finalize that in Q4. So I'm not too sure how the revenues will be recognized over there. But let's assume that you take out 25 million per quarter and attribute that to the acquisition of Zava, which means that their core business, if you take this $634 million minus $25 million from Zava, their core business would need to grow at around would need to generate $609,000 in terms of revenue every single quarter. Now, if you take this, you divide by the Q3 24 numbers. Sorry, let's do that again. This divided by this actually tells you that just by looking at these numbers alone, their core business should re-accelerate back to growth over the next couple of quarters. How they actually, level out the growth so that, not so lumpy, I think that will be up to management, but you can see it's not going to be slow growth by any stretch of the imagination if you take out the GLP-1s and if you offset the Zava revenue from the expectations over here. So because of that, this is not something I am particularly worried about, because this tells me that, hey, if they're confident of hitting $2.4 billion by end of 2025 without the GLP-1s, it means that their core business, if you offset the revenue provided by Zava, is going to have to generate $609 million per quarter on average. And that would mean about a 26 to 50% year-over-year growth in both quarters combined, right? So because of that, like I said, not something I am particularly concerned about. And if you want to make this even more bullish, you have to realize that in Q3 and Q4 of this year, we are comparing to Q3 and Q4 of 2024, right? And in Q3 and Q4 of 2024, you had GLP-1s boosting some of the revenues over there. So actually their core business is growing faster than the numbers that you're seeing on screen. So I think people who are saying that their core business is dead, it is growing slowly, you forget that, you know, the pharmacy capabilities or the pharmacy capacity has a limit. And if GLP-1 was their main growth driver, or they plan to make GLP-1 their main growth driver, that was where the majority of the manufacturing capacity was going towards. And that is why they were not able to grow the other core parts of the business as quickly. However, the fact that they did not revise their revenue guidance for the full year tells me that they can easily shift the product mix back to their core business and start to ramp up growth in those other areas once again to basically make up for the loss of growth in GLP-1s. And because of that, I do think it's bullish, because even if you offset the revenue by Zava, they are still going to be growing at a very healthy clip. Okay, so with that, hi Wen Chang, hello from Taiwan. Yes, so today we're talking about HIMS. I'm not too sure if you invest in HIMS. Right, so basically I'm just addressing one of the concerns that people have around HIMS. I think people don't know how to break down some of these numbers. They just look at the core business and say that it's growing 12%, so it's scary, it's going to die, and things like that. I'm just showing you that, you know, that's not necessarily the case, and what to look out for in Q3 and Q4 of this year to know that that is not going to be the case, right? So similar to the SoFi video, I'm going to be doing a pre-recorded version of this, and then I'll cut up some parts of these live streams as well, in case you missed the front part of the video, right? So you can get a shortened version. Okay, so with that, I will go into the valuation metrics over here. Now, I did it two ways. I did it first by multiple approach, and after the multiple approach, I went to use the DCF as well. So you can compare the two valuations, and you can see which assumptions you are more comfortable. So over here, you get the HIMS subscribers, and then you get the monthly revenue per subscriber. Of course, you then have to convert this into quarterly revenue per subscriber, right? Because monthly is only 1 month, and there's 3 months and a quarter. So you need to multiply this by 3 eventually. Now, then what I've decided to do, if you take a look at this formula over here at the top, it looks a little bit complicated, but basically, when I use the numbers that HIMS give to us, sometimes they give us $53 monthly revenue per subscriber. It's actually $52 and something cents. And because of that, there's a bit of a discrepancy when I use their numbers and compare the online revenue. So because of that, I use the very specific numbers. I use the online revenue, work backwards to find the monthly revenue per subscribers, and use that as how I extrapolated the data. So you can see online revenue has been growing pretty steadily. That has gone up to $81.20. Over a couple of quarters, fell back down. Quarter was around, they reported $74. It's $73.37 over here. Like I said, a lot of this can be due to rounding errors in their number. Not rounding errors, due to rounding out their numbers. They are using an estimation, and so that's why they get $74. But because of accuracy, I work backwards to find out these numbers instead. And then from here, I am assuming this continues to fall next quarter, over the next 2 quarters to $68 and $65, right? And then in 2026, as they scale up their sexual health component, as that becomes more widely adopted, as more and more people switch over to the subscription, the daily premium subscription, compared to the on-demand subscription, I expect this number to go back up. That's the first driver. Second driver of growth, their testosterone business, which is only just being launched yesterday, and then their menopausal business as well. So all these are going to drive up growth in 2026. you compare that with, the slightly more muted growth in 2025, I'm going to expect them to reaccelerate back to growth in 2026, right? So from here, you got the online revenue, you got the wholesale revenue, and then you can get the total revenue per quarter. So this is basically the estimation. And so we are doing this the same way as we do the valuation for SoFi. We don't just assume a growth rate for revenue. We have to reason out why we, expect different things in different parts of their business. And so you can see customer growth, we expect. You see, they have never grown at 30% year over year before, but that is what I'm expecting over the next 2 quarters, which means that, they can definitely do more than that. And I don't expect them to re-accelerate back to 40% growth for the rest of the decade. And even then, you're going to notice that they can hit their 2030 number. So, of course, what I've done, otherwise, because I'll end up, if I did everything in a whole straight line, I would run out on this Excel. So what I've done is, at least in the first 4 years, everything is done through analyzing the business and then extrapolating the data from there. And that's how we get the average revenue over here. So you can see in 2025, even if we assume that they don't hit their adjusted net revenue target of $2.4 billion, they would still be growing at 52.8% this year, which is not too bad, right? But that's the worst case scenario. Then from there, let's say the growth rate halves again in 2026, which is unlikely because Yemi has just told us that they plan to, once they lap the slower growth in 2025, they should re-accelerate back to growth. But let's assume it halves, right? You get $2.8 billion. That stays relatively consistent in 26 and 27 based on the numbers that we've done. And then growth rates decelerate through the end of the decade, 25%, 20%, 20%. And here, the number over here, if you remember, Andrew Dudum has told us, hey, we expect $6.5 billion by 2030. That is how they get there. Halving the growth rate next year and then continue to slow down every single year until 2030. That is how they get there, right? And then, of course, adjusted EBITDA, they expect 1.3 billion. Okay, so net income, we are doing 24%, right? I think because their low end of the guidance was 20, high end was 30. So I just took a number that was in between. Because honestly, like this is 5 years from now, nobody knows for sure what is going to happen. Okay. So in terms of shares outstanding, of course, we know that they bought back shares, but let's just assume dilution, worst case scenario. And then this is the EPS over the next couple of years. So with this, what I've done, very simple. You take the comms, I'm looking at 2026. I'm assuming a 60 times PE. Why am I doing that? Because that's the valuation that slightly lower than what they are trading at. Lily, a mature company, is still doing 50 times PE, and TMDX is around 60 as well. So let's just assume end of next year 60. I think that's a fairly average estimate in terms of the entire industry. Okay, so assumption over here, market is fine, and they're trading more or less at industry average. And if that is the case, with $1.97 EPS, they would have a price target at the end of next year at around $118, right? And today they are in the $50 ranges, if I'm not wrong. How much are they today? They are $52.62. So that's more than a double by next year, right? I do think that if they show re-acceleration of their core business without GLP-1s, I think that is the main concern. If they can show that, I think investors should be more comfortable with owning their business. But I think as a retail investor, the edge that we have is that, we can amalgamate all this data from HIMS House and different places like that. Hopefully we piece this story together faster than Wall Street can, and then we can get in earlier in these times where we can see the data for ourselves and we don't need to justify to a higher up in order to make this purchase over here. And because of that, that gives us the edge that we have over Wall Street. At least that's what I believe. And so, like I said, I have broken down. It seems like their core business is slowing because they are trying to drive growth through GLP-1s. Now, without that, the fact that they did not lower their revenue guidance tells me that they feel confident about driving growth back into their core segments. And I believe that, this is going to result in, about a 30-40% kind of year-over-year growth. Because last year, I just want to show you this particular statement made in Q4 of 2024. This is the last thing I'm going to say about that. Then we're going to look at the DCF, okay? So basically, last in Q4 24, I think the current expectations that I have of around 30 to 40% year-over-year growth in their core business segments is fairly in line with what their CFO Yemi told us last year. So I'm just going to show you this. Okay, if I'm not wrong, let's go back to, if I'm not wrong, it's in Q4. Is it Q4 2024? I'm pretty sure it's Q4. Okay, I want you to read this segment over here if you can. Let me zoom it in. Hopefully it's bigger. Revenue outside of our GLP-1 offering increased 43% year over year to $1.2 billion in 2024, reflecting an ability to achieve the floor of our revenue expectations for 2025 a year early. Expansion of personalized treatments on our platform is continuing to result in strong subscriber growth. So what this tells you is that even without GLP-1, this is a business that can grow at 40%, over 40% year over year. And that is basically something that we would consider already in the hyper growth phase of the aspect of the business, right? It's one of those companies that we would consider in hyper growth. And I think the numbers that we just worked out, having year-over-year revenue growth between 26 and 50%, even though you're comparing with quarters that have GLP-1s, already proved to me that this 40% number is something that they can replicate this year again. And if they do that, then I think investors will feel a little bit more confident coming into the stock. Because I think now, if you take a look at the core business number, that 20 and that 12% year-over-year growth is actually quite scary. But from what I see, it's a large part of our 503B facilities have been dedicated to producing GLP-1s. Now, with that not possible anymore, this can go back to drive growth in their other business verticals. So that is what I am looking out for going into Q3 earnings. If I see a re-acceleration in their core business, I will be adding more. If I don't, I'm not selling, but I will be definitely holding shares and then basically seeing what's going to happen from there. Right. I think one of the reasons why I've been a little bit more aggressive selling covered calls and HIMS is because of the risk of lawsuits, and I just wanted to play the volatility. But if the risk of lawsuit is diminished, if they show growth coming back into their core business segments, then I will be adding more. Because like I said, right now, if you're just looking purely at a multiple basis, people will tell you to use 20 times, 30 times PE. Fact of the matter is, how often do companies actually trade there until they become until and unless they become bigger companies, then their multiples would start to normalize in that range. And I think to expect that over the next 3 to 4 years for HIMS is a little bit unreasonable, because if you can see some of the biggest companies like Eli Lilly is still trading at a 50 times PE. So you can't say that HIMS has to be trading at a 20 to 30 times. Right, so let's go back to our valuation. Okay, so with HIMS, when it comes to the valuation, let me zoom into the DCF. So you can see the DCF valuation is slightly lower. Earlier on, we had $118 as our price target. Right now, if you use the DCF, you get $82. Why $82? Because, like I said, not fully optimized for cash flow. Plus, at the same time, in the most recent quarter, their cash flow came in negative, so it made the results a little more volatile, harder to predict. Okay, so all these are just the annual revenue numbers that we have gotten, and then you can get the cash flow from operations over here. You can see the growth in cash flow, not very high. And then, cash flow margins fell as well, right? CapEx has increased greatly. You can see previously, this was like 1%, 0%, 2%. And then this suddenly jumped up 3x to around 6% over here. And then because of that, you can see that there's a hit in their free cash flow. But like I said, because we know that they are reinvesting back into the business, not something I'm concerned with. And also why this valuation is a little bit unreliable when it comes to companies that are still growing, because their main focus right now is to continue investing into the company to build up more verticals of growth rather than generate a high amount of free cash flow, which is why in my framework, I actually don't penalize some of the smaller companies for more irregular cash flows as long as it is trending in the right direction. And I think we can say that for HIMS, I think earlier on when we looked at the graph, that the cash flow for HIMS really is moving in the right direction, and it's not something that I am particularly concerned about. Now, cash on hand, HIMS has around $1.14 billion as well as $900 million in debt. Now, this $900 million in debt is basically what they have raised through their senior convertible notes, so not to worry over here. And because of that, with the number of shares outstanding, you get a share price of $59.24. Then, moving forward, EBITDA margins, I am only assuming 21%, which means that by 2030, EBITDA margins would be 21%. Their guidance is 20 to 30. We are using 21%. Then right now, their EBITDA, EV to EBITDA ratio stands at around 60 times. Now, I'm assuming that in 5 years, this will decrease all the way back down to 20, right? If you 20 times EV to EBITDA, then you will get a share price of $123.15. Now, what I would like to do usually is that I will combine both of these approach and to get an implied share price of around $91.19. So if you think that these assumptions over here of growth, right? If you think that these assumptions of growth over here are okay, slightly over 30%. Oh, sorry. Just now I was using 2250. Okay, 50% of growth. Let me just take the number that I was using earlier on. Because I use this 2 million number is their trailing 12-month number. I guess that's it. Actually, that's even more conservative. You know what? I'm just going to keep it as their trailing 12-month number. No problem. Let's keep it as their trailing 12-month number. It's going to be, yeah, so that means even if HIMS doesn't grow for the rest of the year, you just assume that their trailing 12-month number is their final result at the end of the year. Okay. Then next year, they grow at 32%, 27, 25, 25, 25. They still get to their $6.5 billion that they have guided for. And even if you use a 10% margin of safety, I would say that if some of you might be a little bit more uncomfortable because of the lawsuit, you might want to do a 15% margin of safety. Then that would bring the price target to around $77.50 with a potential upside of $47%. Now, the reason why you see an X over here is that because potential upsides, usually I like to invest in companies with at least a 50% upside within a year, or projected 50% upside within a year. Nothing is confirmed, right? However, with HIMS, like I said, a lot of these models, they are just models. The numbers are dead. It is an Excel file. You have to understand it. 1 quarter ago or 2 quarters ago, they didn't have this senior convertible debt. If I put this to 0, this goes back up to 50%. Does it really matter? It doesn't, because we know that this debt that they took out is for further acquisitions to grow the business. So this is really numbers on a spreadsheet. You can change whatever you want. The whole point of this is not to change the numbers to make this become a tick. The point of this spreadsheet is to change the numbers in a way where you are comfortable with the assumptions. So with me, I am no longer worried about the lawsuit compared to right after their Q2 results, which is why I've lowered the margin of safety from 15 to 10%. Previously, I believe I used 15% for HIMS. Because of the lawsuit, lowered this back now to 10. This 10% risk is basically the core business and still slight lawsuit risk. That's why it's 10% margin of safety. Right. So like I said, this is really not a big deal. And yeah, so I think with that, I would say fair value for HIMS would be close to the $80 range, and which is why I have sold covered calls usually in the $70 range or so, right? And then if it gets a sign, it gets a sign, and then I'll just redeploy the capital again back to selling cash account puts. And so with that, I've come to the end of this analysis of HIMS. Like I said, thank you for your time. And for those of you who join in halfway, you might be a little bit lost. Not to worry, I will repurpose this into a shorter form video. So for those of you who didn't catch the whole thing, of course, you can rewind back. I'll be adding chapters to some of these live streams over the weekend. But at the same time, I'll also be cutting this up into a shorter form video where you can just listen to it in maybe 20 to 30 minutes and get the gist of the whole thing. Because sometimes in between, I'm answering questions that asked along the way. All right, so with that, we will bring the live stream to a close tonight. Have a great weekend, everybody. And I will see you next Monday for Grab. And I think Grab is doing very well today. So, all right. See you. Have a good evening, everybody.